sucker like me. My broker has the obligation to get me the best price, though. He's going to check Margie's bid, your bid, and everyone else's bid. In a competitive market with enough clever traders, I'm going to get right around $390 for my shares, whether I panic or not. If there are enough clever investors competing, then the price will be fair, even with a bunch of panicked investors. That's why behavioral finance needs to limit the amount of trading that these clever people can do. Otherwise, their theory breaks down because emotional traders don't make any difference to prices. I'm not sure I buy the behavioral finance story. I think that behavior finance can help us the most by identifying the emotional pattern behind the temptation to make mistakes. Have you noticed that you put more weight on the opinions of those who agree with you? That would be an example of what's known as confirmation bias. We tend to find evidence that supports the things we already believe. Do you find yourself reading articles and watching shows that agree with your political opinions and skipping those that disagree? I'll bet that you do. We tend to interpret "he agrees with me" to mean he's a smart guy, don't we? Lots of investors succumb to this. They have an opinion of a stock, then they find a bunch of stock research that supports their opinion. The portfolio advice from this insight is that you're going to be tempted to stick with a mistake too long. If you think financial advisors can pick winners for you, then you're more likely to accept arguments that explain any poor performance he might produce. Instead of waiting until several years of bad performance have already occurred to decide whether to find a new advisor, decide what your trigger point is ahead of time. Maybe you'll tolerate 1 year of being 10% below the market, but not 2. Whatever it is, decide. If you hit your trigger point, then follow through with your decision and replace your advisor. If you wait to decide until after a string of bad years, then you're more likely to be persuaded by excuses that fit with your bias. Most people are prone to being overconfident. This fits with the old adage, "A little knowledge is a dangerous thing." Overconfidence bias boils down to thinking that you have a skill or advantage that other people don't have. A person with a pilot's license might rightfully believe that he knows more about airlines than other people, but that doesn't mean he can invest in the airline sector with more success. The biggest danger from overconfidence bias is probably that it convinces you to trade more. That's more likely to run up transactions costs than anything else. At some point of your career, you'll own a stock that's been a disaster. You can't even think of it without feeling sick. Loss aversion bias makes it hard to admit that the loss is real, and you hang on to the stock telling yourself, "I just want to get my money back." That's loss aversion bias at work, tempting you to make a mistake. You'd be better off selling that loser. We'll see in Lecture 14 that the Internal Revenue Service gives you a big incentive to sell. If you don't, then you're passing up a nice tax deduction. As you journey through your investing career, see if you can catch yourself gathering information that agrees with you, feeling overconfident, or being unable to admit a mistake or to accept a bad outcome. I'll bet it happens a lot more than once. You know by now that I think the stock market is pretty darn efficient. Not perfectly efficient, but close enough for people like us to treat it as efficient. That said, there are a few intriguing observations we can make that can help us invest more wisely, perhaps. First, 2 sets of market experts, Professors Andrew Lo and Craig McKinley, as well as Professors Jennifer Conrad and Gautam Kaul, found that over short horizons, maybe a few weeks, stock market trends tend to persist. Good weeks tend to be followed by good weeks, and bad weeks tend to be followed by bad ones. Weekly stock returns seem to have a little momentum with emphasis on the word little. Later, Professors Narasimhan Jagadish and Sheridan Titman demonstrated that portfolios of stocks that did well over a period of a few months to a year tended to do well over the next